All right, we're gonna get started here. I started a little bit late today. So let's get started. Okay, so I'm gonna keep this class super simple um, and just kind of teaching you guys how to pick the highest quality option contracts, right? And so what we're gonna do is we're just gonna take a look at probably some liquid stocks, some non-liquid stocks, talk about them a little bit, and how to pick the best option contracts. Okay, so in my opinion, we as a Discord, as a trading community, as Twitter, like, and this goes for like Twitter, um, Instagram, whatever social media you use that talks about trading, a lot of the time they trade, for lack of better term, piss poor options contracts. Like they trade really crappy options contracts. And so they give people the wrong idea of what you should be trading that's going to make you money on a consistent long-term basis. I think a lot of people like the idea of cheap contracts. And you've heard the saying, it takes money to make money. It's kind of a real thing. And you just don't want to trade these poor options contracts. Like you want to get to as close to trading the stock as you possibly can. Okay, so let's talk about this a little bit. So we can first go into expiration. So talking about expiration, a lot of people are going to trade. They're going to try to trade 0 day to expiration, 1 day to expiration, 3 day, whatever, these really short term options contracts. And it's just, in my opinion, very unwise. Doesn't make sense to me at all. Like you're trading these contracts that expire today, unless you think the stock is going to skyrocket, in which, if you're a newer trader doing it less than 3 years, then I would not be trading these. Like, in a lot of the times that even I don't trade these. I don't like to trade these. I think they're a waste of money, right? And sometimes they can pay, but a lot of times you want to be the one selling these contracts, like not buying them. Okay. And so let's talk about a little bit with what contracts we should be picking. And if you want to make it super simple for yourself, even if you are day trading something, you should be buying at least a week out, at least, like if not 30 days out. If you are planning on holding it overnight, you really should think about holding them longer than that. So like at least 30 days to expiration, right? And we can kind of talk about why and stuff like that, but we'll just stick with that mantra of, like, you want to pick at least a week out, even if you're planning on day trading it. Like if you're planning on day trading it, 7 days usually can be pretty good. But if you're planning on swinging, just go, even if you're planning on holding it for 2 days, like get 30 days out. It will save you a lot of headaches, a lot of problems. I'm sure everyone has been there when they have scalping. Yeah, somebody said, what about scalping? Yeah, I would even buy 7 days out. Like, and I think that's just wise. Okay. And because you're buying higher quality contracts. And um we'll get into why. But like I think a lot of what people will do is they buy these contracts because they're cheap. Well, they're cheap for a reason. There's a reason the contracts are cheap. Like because they're shit. Lack of better term, they're not any good, right? And so we want to trade, like if we want to make a consistent income out of this, I guarantee you people have been in a trade and they're like, the stock is moving my way. It's moved a good bit in my way, and I'm still down on the contract. That's because you picked a bad contract. Or the contract hasn't, or the stock hasn't moved at all, but I'm down 20% of my contracts. It's because you picked a bad contract. It's because you're picking crappy contracts. And we're going to get into like how you can start picking better contracts and higher quality contracts, right? Okay. So number one, they need to be liquid. and we're going to get into all these pieces, right? So let's just take a look at the options chain. Let's say we wanted to look at the S&P 5 or QQQ for that matter. And we wanted to look at, okay, how are we going to get, or how are we going to pick an options contract? Let's say we're bearish on it. We think this can't be right. $60. Oh, okay. That makes sense. Okay. So now we're looking at this. All right. So let's say we want to buy an options contract and we think the market is going to go up from here. I'm not saying that I think the market's going to go up from here. I'm just saying let's use it for an example, right? And let's add theta in here. Cool. Okay. So now these are the pieces we want to pay attention to. That's why I added that in. Okay. So when we're looking at a stock and we're trying to pick an options contract, let's say we think the S&P 500 is going to go, or QQQ is going to go up from here. And so we want to buy calls. Okay. And so this is just an example. So what we want to look at is we want to look at first the cost, right? First thing we want to pay attention to. Easiest thing I can tell you, honestly, is buy one that's at the money. What do I mean by at the money? Okay. So there's in the money, which is this here. This is in the money. This blue here is in the money. That means the contract or that strike price here. So this is the strike price. So 34, 364, 365, 366, 360, 375. All these are strike prices. This right here is the expiration date. Okay. And so if it is blue, that means the price is for calls is above that level. So that means it's quote unquote in the money. So we're at 366 right now. So the 366, we're at 366.42. So the 366 call is in the money because we already passed that price. The 365 is in the money. The 364 is in the money, but the 367 is not in the money, which means that that's what this is, right? So that means we're at 366.42. So the price is now below 367, which makes this out of the money. What does that mean for us? That means any of these ones in dark or black are all premium, meaning they are all cost. Their cost is based on the value of time and the amount that it could possibly move. Like there's things called intrinsic value and extrinsic value. These ones in here are in the money are a mix of intrinsic value and extrinsic value. This all here out of the money is all extrinsic value. Like because we are past the strike price means there is some money in here. Let's see if we can do this. Cool. Nice. Okay. Awesome. So now we can actually look at this from a real perspective. Okay. What? It's not. Whoops. Okay. So now look at this. So this is the price, right? So this here, this is the intrinsic. You can see it here, extrinsic. Okay. There is $85 in this contract of the $974 of real value in it. Like there's actual real value because of where the price is at. This here, there's $886 worth of real value in this stock or in this options contract because it's in the money. Now, if you look further, like here at the 360 right here, there's $685 worth of real value in this. There's $684 of non-real value in this. Or Yeah. Okay, so I'm saying that right. Now, if we look at these outside of here, there's no intrinsic value on any of these contracts here. It's all extrinsic value. So if it, when we get to September 15th, and let's say we close at 366.42, all of these in black will be worthless. They will be worth nothing. Absolutely nothing. Zero. This will have 82 bucks, this around 82 bucks. Well, it's changing now, but 80 bucks, 180, 280, around there, right around that number, right? And so that's why it matters when we're picking contracts. Some of these have real value in them and some do not. The ones in the money have some real value in it because of where the price is at. And so these do not, because it's below where the actual price is. Because all these contracts are is you are borrowing, you're buying shares, you're getting a contract to have the rights to shares at a certain price, whether that's 367, 366, 365, 364, so on and so forth. Okay, so now that's what you can look at. Now, I hope that, let me know if that doesn't make sense in the chat. But all of this is extrinsic value. It'll be worth nothing, and it's, you can call it time value. This value is how much the contract is worth based on the amount of time until the expiration, because it will be worth nothing by the time the expiration comes. Okay, so now let's look at this a little different. Next point we're looking at. Okay, implied volatility. I'm just going to kind of give you rules of thumbs to make it a lot simpler. So implied volatility basically measures how volatile the stock is and the options contract and how much it might move during that time period. 19% is pretty low in general terms, but when you're looking at this and you're looking, let's say you're looking to trade an abnormal stock, something that's different, you want to look at you want to make sure this is generally under 80%. That's a good rule of thumb to use. Like, you want to find options contracts that are under, the implied volatility is under 80%. Okay, these are obviously under 80%, but like if we go look at maybe Upstart, yeah, you can see these are at 106. And why this matters is if it goes, so you're, what's the easiest way to put this? As with the implied volatility, this is part of what prices the options contracts. So if this flushes to 50, you're going to lose a lot of money on your contracts because the implied volatility went down. So then it will be worth a whole lot less. So like if this goes down 10%, you're going to be losing money on your contracts just from holding it because the implied volatility is going down. So like, but now think about it from the opposite perspective. If this is at 20%, like AKA when you're in a squeeze, and this shoots up to 50%, that's going to add value to your options contracts. Because think about it. This is a $33 stock, but the contracts are $335. Now go look at QQQ. Let's look at Apple. That might be easier example. Okay, so now think about this. The at the money contracts for Apple, same expiration, are $350. And it's $177 stock. Okay, now if we look at Upstart, this is a $33 stock and the contracts are $335. That's because of implied volatility. The stock is very volatile. So when it moves, it is going to affect, or how crazy the stock moves is going to affect the cost of the options contracts. And when the implied volatility, the idea is you want to buy these when the implied volatility is low and sell them when it gets high. When it gets high, that means your contracts increase in value when the implied volatility moves up. Okay, so now let's go back to QQQ. Okay, so now when we look at this, that's the next thing. So general rule of thumb, you want to keep it under 80%. It's okay if you have it over 100. I mean, like it's okay if it's a little above 80, but really you're pushing it. Under 100 is really like a no-no kind of thing. And so now let's move to the next thing. Okay, so theta. What is theta? This is a part of the Greeks. Theta is how much money you're going to lose on the options contract per day. Okay, per day of holding this. And no, it's not just during the market hours. It happens while the market's closed as well. It will gradually tick off this $16 per day until option expiration. Now you can see the value stays pretty similar, right, as we go up. But look at how much more worth these contracts are. So you're losing the same value on a $900 options contract versus a $2,000 contract. You're losing the same amount of money. Okay? So think about that for a minute, right? Okay. So this, I don't really have a rule of thumb for this, but obviously it's self-explanatory. The amount of money you lose per day. I mean, if you look down here, you're losing 11, but the contract is only worth. So basically, you're losing about 5% a day. Pretty close, if I'm doing the math right. Yeah, pretty close to 5% a day. Nah, my math's off. But either way, you're losing $11 a day on a $290 contract. Okay, so this is just to keep you in perspective how much money you're losing. Okay, so a good example, look at this. So contracts that expire tomorrow, this contract right here, it's $146. It's going to lose $144 tomorrow. It's going to lose that much value. So that is something to think about when you are looking to take a trade. Okay, that's how much value it's going to lose in the day. Just by holding it, it's going to lose $144 as you hold it. Like, so say if you bought this in the morning, it closed at the same spot, it's going to be worthless, right? It's going to lose all of its value. And you can see 101, it's going to lose $101. Basically, all the premium is going to be gone. But now let's look at maybe 7 days away. So this one is going to lose pretty much close to 10% every day that you hold it. This contract, it's going to lose 10%. Okay, now let's go back to, I hope that makes sense. So that's something you want to pay attention to, how much money you're going to lose per day holding it, just when you're trying to pick a profit target and how much you're expecting it to move. Okay, next part, this is the fun part. So delta. Forgot to mention, theta, this will increase as it gets closer to expiration. So as it gets closer to expiration, this theta decay is going to increase. Like, as you can see, this is 0.16 now, but in 2 days, it's 0.80. So it increases the closer you get to expiration. That's why it's better to buy contracts with time. You're not going to get screwed with theta decay. You have more of a chance of it working out if you buy time on it, and you're not going to be losing a whole bunch of money. This is what happens. Either implied volatility goes down. If your stock stays the same and you're like, oh, why am I down 20%? It's either because of theta or because implied volatility. Okay, so now we go here. Let's go back. Okay, so now this is the fun part. Delta. So this is how much money you make per dollar the stock moves. Okay, so you can see it goes up as you get more in the money or closer to at the money for this case. So like down here, you can see it will move $26. You'll make $26 per dollar the contract or the stock moves. You'll make $26, $28, $30, $32. And as it moves up, so like as it approaches your profit target or moves further in the money, or it's moving your way, it's going to increase. The delta is going to increase as it moves up. So that's a benefit of options contracts. As the more you're right, the more money you're going to get per dollar it goes up. Now, but notice the ratios here. Okay, here I'm making on this contract here, I'm making $53 per dollar it moves, but I'm losing $16. This one here, I'm making $26 per contract, and I'm losing $11 per day from holding it. Okay, so that's what you're looking at. So the delta moves up as it moves your way. As it moves away from where you're going, the delta is going to decrease, which can benefit you as well, but not that much, right? It's going to help you more as it moves further and further towards what you want to see, right? Okay. So that's that. So basically, this is delta is how much money you'll make per dollar it moves. And the further it moves in your direction, the more money you're going to make per dollar. It doesn't change like a crazy amount. You can see it like changes like 2 cents per dollar it moves, but like kind of consistently throughout here. But yeah, it's good to know. So it moves up further. You'll make more money per dollar as it continues to move in your direction. If it moves lower in your direction, it's going to do the opposite. It's going to move less per dollar that it moves in the opposite direction. Okay. Next thing is open interest. So this one, this is important in picking options contracts. And this basically tells you how many people have an open position in this contract. And it only updates at the beginning of the day. So like when the market opens, it'll update, but it doesn't update throughout the day, but it will tell you basically, okay, this is how much the value you're going to make per, per contract. Sorry, I completely lost my train of thought. No, this is telling you how many options contracts are open, how many open positions people have in this contract. So like, for example, this options contract here, there's 5,604 open positions when the market opened. Okay. So 5,604 positions are open on this contract. This contract here, 42,489 open positions in this contract as of the start of today. Okay. So this can give you insight into the more open interest, the better. It'll make your contract more liquid. It'll make it easier to get in and out of the contracts. It'll keep the spread, like the bid and ask price, a lot tighter. It will help with that. So the more open interest, the better. And the rule of thumb I'll use for that, like obviously you can see all of these are high, but because it's QQQ and it's a very liquid stock, what you want to do is you want to pick ones that have at least 1,000 open interest. Like let's go to Upstart. That would be a good example, I think. See this one, some of these do not have open interest of over 1,000. Like this one here has only 917. This has 506. This has 310. Let's look at another one. This one here, so you can see this has like no liquidity. 228, 150, 66, 390, 239, so on and so forth. This is not a liquid options chain, right? There's not much liquidity. Now, if we go look at like this one, still low. We look at this one, it's probably really low. Yep, see, only 8 open positions in this contract. And you want demand on these contracts. Nobody's going to buy it, doesn't move very well. So you will definitely want to pay attention to, that's probably one of the most important pieces of this, is you want to make sure this has over 1,000. That's very key. Okay, so that's one thing you really want to pay attention to. Next, you want to look at volume. So this is more for my day traders. You want to pick something that has a lot of volume, because and this does update throughout the day, but you want to pay attention to this because it will this is how you get in and out of contracts. If there's a lot of volume, that means there's a lot of contracts being traded, and that means you could probably get out of the contracts pretty easy. So that's something you want to pay attention to. If there's low volume, it's going to be harder to get out of a contract because it's not being traded very much. So that's what the volume tells you. So a good rule of thumb for that one for like a day trader would be 1,000, right? So going through, if you kind of want to have like a checklist for this. So I would say the best options are the best contracts to pick. I would say at least 30 days out. even if you're taking a day trade, you're just going to get way better quality contracts. They're just like, stick to these monthly expirations, right? So like, as you can see how it says weekly, 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 stuff like that. And then there's this one here, August 18th, that's a monthly expiration. September 15th, that's a monthly expiration. October or 20th of October, monthly expiration. 17th, it's the third week of each month. So the best ones to pick, I would say, and usually are the most liquid because that's what the big money trades, are these monthly expiration contracts. So I would definitely lean towards taking those types of contracts. It's usually going to be a lot better for you. So even if you're taking a day trade, I'd recommend just go ahead and stick with the monthly expirations. It's just going to get you a better quality contract. Okay. So that's the first thing. I would stick to like 30 days out, even if it's a day trade, because the gains might not look as pretty, but you're still making relatively the same money and you're buying way better contracts, and you're not going to get all screwed up and be down on contracts when you really should be winning on them. So that's what I would say for that. So 30 days out, at least 7 days out, but preferably 30. Even if you're taking a day trade, just to be safe, buying high quality, good to go. You want to have at least 7 days, right? Next step is I would want to buy as close to at the money or in the money that you can, just because there's going to be some intrinsic value in it. It's going to be a higher quality contract. Your per dollar it moves is going to be much higher. So as you can see, it's moving $53 versus 26. The theta is going to be more in your favor versus this is about, the theta is moving about half of what it will move per dollar versus this one. It's about a third. And so that's how you kind of want to pick the contracts. It just makes them higher quality. And so I would say at the money contracts, that's definitely what I would go to. I would not buy far out of the money contracts. I really don't like that, and I hate to see that in the Discord, so don't post it. So basically look at the money contracts. Those are the higher quality contracts. Yeah, you're going to pay more, but you're going to get better bang for your buck for sure. And it's just, yeah, you got to spend money to make money. You got to pay for the good quality contracts. Okay, so first thing is you want to buy at least 7 days out, preferably 30, even if you're day trading. If you're holding it overnight, definitely buy at least 30, right? Definitely buy at least 30 days out if you're holding it overnight, even if you're going to plan on holding it for a day or two. Then what you want to do is you want to pick an at the money contract. Next, you want to make sure that it's under 80%. Easy rule of thumb. Then lastly, you want to look at, okay, we need over 1,000 on open interest and over 1,000 on volume. Volume is not as important if you're swing trading it, but it is important if you're day trading it. Easiest way to knock out all these rules, right, is if you trade highly liquid stocks. Like if we look at Apple, you can see 40,000 open interest, 3,500 volume today, and right at the money, we're good to go. Let's see, very solid. But if you're trading weird off the wall stocks, like, let's see what TJ Maxx looks like. See, that's pretty good, right? 1,000, 2,000, 3,000. You can find some good contracts in here. Let's see, like Tesla will have good open interest. A lot of people are playing this. You can see pretty solid open interest. Netflix, good open interest. Snow, not as good. As you can see, not as good. Right? So, yeah, so you want to kind of stick to those highly liquid stocks. NVIDIA, look at very good. Very good. SPY, probably the most liquid one out of all of them. You can see these contracts, very liquid. Okay, Apple actually had a lot of open interest. But yeah, okay, so that's kind of the checklist. What you want to look for is like 30 days out, definitely if you're holding it overnight. And then you want to pick at the money contracts. If you're not going to buy at the money and you're going to be a DGen, at least buy ones that have you have to have open interest. Have to have open interest of over 1,000, and then pick numbers based on whole numbers, kind of like 440, 445, multiples of 5, right? So 445, 435, 445, 455, 5, 10, 15, 20, 35, 40, you know what I'm saying? Okay, that's what you're looking for. You want to pick those types of contracts that are nice round numbers. And then, so keeping it very simple, LEAP contract should also have 1,000 open interest. Yes, yeah, definitely. Any contracts you pick, you want to have over 1,000 open interest. So break it down, really simple. Okay. At least 30 days on your contracts. If you're day trading, you can do 7, but it's even better to do 30. So you might as well just stick with the rule of 30, right? And if you do that, so if you're holding overnight, you got to have over 30. It's going to save you in the long run, right? Okay, then you want to pick at the money or in the money contracts. I would pick anywhere between like here, slightly out of the money here, all the way to 0.70 delta right here. So out of the money or at the money or in the money, right? That's what you want to be looking at. Suckers buy these ones down here, okay? The suckers buy the cheap ones down here. Then, so first we got the expiration down. We've got where we want to buy at. Then we want to look for open interest. So like in this example here, there's 8,000 open interest here, but there's 27,000 open interest here. I'd probably go with this one because the open interest is much higher. So you want to pay attention to that. This one or this one of these two, 17,000, 20,000 versus 8,000. Typically would probably go with this one right here. Okay. Or look at this one, 55,000 open interest. Probably a good one to pick, right? There's a lot of people in it. Okay. And then, so you have your, I know I'm kind of being redundant, but I think it helps. So you want to have 30 days out. Then you want to pick at the money or in the money. And then you want to check the open interest for over 1,000. And then implied volatility under 80%. And then volume, if you're day trading it, you want to see over 1,000. Good? Questions, concerns, comments? Does the delta indicate a change in price in case of the dollar movement in either direction? Yeah, so the delta changes. So like right here, if it moves up $1, you'll make $53 on your contract. If it moves down $1, you'll lose $53 on your contract. Any other questions? Good. All righty. Thank you guys for coming. See you for the markets tomorrow. Don't expect too much. We got FOMC tomorrow. Yeah, we got FOMC, so probably won't be much action until after that at 2 o'clock. It's just the Fed minutes. It's not a regular meeting. It's just the notes from July's session, but still important. All righty, guys. Have a good night. Thank you, Sebi. Thank you guys for coming. Appreciate it. Have a good rest of your night. If you didn't catch the recording, a lot of you guys are Signals members. Make sure you catch the recording of the video I just did. I'm about to post it in the OT chat, and you'll be good to go. All righty. Have a good night.